Most people only see the buying and selling side of real estate, but behind every successful investment is a deeper system of research, timing, risk analysis, and strategic execution. In this section, we are stepping behind the scenes of the intermediate level business structure behind GHL India Asset's investment operations, uncovering how real opportunities are identified, how risks are filtered before acquisition, how multiple projects are strategically managed, and how market cycles are used to maximize timing and profitability. This is where property investing moves beyond theory and starts to reveal the real strategy behind smart real estate execution. Let's begin. First question: how do you identify distressed or undervalued properties? At GHL India Asset, distressed and undervalued properties are identified through a combination of local market intelligence, seller agent networks, data-driven market analysis, strategic screening criteria. GHL has built an extensive sourcing ecosystem through a large network of real estate agents and local market participants. How the identification process works? Number 1. Seller agent network. We source opportunities through local brokers, seller agents, direct owner relationships, distress-driven market referrals. These are typically situations where owners require urgent liquidity, assets are under-marketed, pricing is below fair market value. Number 2. Market cycle analysis. GHL focuses on Tier 2 growth markets, recovery and expansion phase opportunities. We study infrastructure growth, demand patterns, transaction activity, future development corridors. This helps identify assets before peak pricing. Number 3. Pestle-based evaluation. Each property acquisition undergoes political, economical, social, technological, legal, and environmental analysis. This ensures the opportunity is fundamentally strong, not just cheap. Number 4. Valuation gap assessment. We compare distressed selling price, fair market valuation, exit potential. The objective is to create a strong acquisition margin before entering the deal. Number 5. Legal and liquidity screening. Properties are shortlisted only after document verification, encumbrance review, zoning validation, exit feasibility assessment. This reduces hidden risk. We don't chase cheap properties. We look for mispriced opportunities with strong exit visibility. We identify undervalued properties through local networks, market cycle analysis, and deep legal and valuation screening. Our sourcing advantage comes from information asymmetry and local market intelligence. The right deal is found through research, not luck. Second question: what is your due diligence process before acquisition? At GHL India Asset, every property acquisition undergoes a multi-layered due diligence process before any investment decision is made. The objective is not just to identify upside potential, but to eliminate avoidable legal, financial, and execution risk before capital deployment. Key stages of due diligence. Number 1. Legal verification. We verify ownership title, chain of documents, encumbrances or disputes, litigation exposure, registration validity. This ensures clean and enforceable ownership. Number 2. Zoning and regulatory validation. Master plan zoning is reviewed. Necessary regulatory validations are obtained from the town and country planning authorities. This ensures regulatory compliance and future usability. Number 3. Market and location analysis. We evaluate demand supply trends, infrastructure growth, transaction velocity, exit potential, market cycle positioning. This prevents investment in low liquidity or speculative areas. Number 4. Pestle risk assessment. Each deal is evaluated across political factors, economical factors, social factors, technological factors, legal factors, and environmental factors. This helps identify micro and macroeconomic and execution risk early. Number 5. Independent valuation. Properties will undergo government-aligned valuation, fair market value assessment. This ensures disciplined acquisition pricing. Number 6. Exit feasibility analysis. Before acquisition itself, we study buyer demand, liquidity potential, resale positioning, developer interest. Our focus is on exit visibility, not just acquisition discount. We evaluate downside protection first, returns second. Before buying any property, we verify legal title, zoning, valuation, market demand, and exit potential. We reject opportunities that fail our legal, liquidity, or valuation filters, even if returns appear attractive. Our due diligence is designed to reduce surprises before investor capital is deployed. Third question: how long is a typical property holding cycle? At GHL India Asset, the typical holding cycle for a property generally ranges from 6 to 10 months, depending on asset type, market conditions, liquidity environment, exit timing strategy. The objective is not to hold assets indefinitely, but to execute a disciplined buy, enhance, exit cycle within a structured investment time frame. What determines the holding period? Number 1. Nature of the asset. Residential plots may move faster. Larger commercial or strategic land parcels may require longer exit cycles. Number 2. Market cycle timing. Entry during recovery or bottom phases. Exit during expansion phases. Timing optimization directly impacts holding duration. Number 3. Buyer liquidity and demand. The speed of exit depends on developer demand, transaction activity, market sentiment, funding environment. Number 4. Value enhancement process. Certain properties may require documentation cleanup, legal clearance, market repositioning. These steps can improve exit value but may extend timelines slightly. GHL's approach to holding periods. The focus is on capital efficiency, controlled risk exposure, predictable execution cycles rather than speculative long-term holding. We focus on efficient capital rotation, not indefinite land banking. We prioritize liquidity visibility before entering a deal, which helps maintain efficient holding cycles. Most projects are structured within a 6 to 10 month cycle, depending on market conditions and exit timing. Our strategy is built around disciplined exits, not long-term speculation. Fourth question: how many projects run simultaneously? The number of projects operated simultaneously depends on market opportunities available, capital deployment capacity, operational bandwidth, risk management considerations. At GHL India Asset, the focus is not on maximizing the number of projects, but on maintaining execution quality, due diligence standards, controlled risk exposure, efficient exits. Each project is executed through a separate SPV structure, allowing operational clarity and project level monitoring. How GHL manages multiple projects? Number 1. Independent SPV structure. Each project has separate legal entity, separate cash flow, separate investor structure, separate asset security. This helps scale without mixing risk. Number 2. Centralized execution platform. GHL manages acquisition, due diligence, legal processes, investor servicing, exit management through a centralized operating system and professional team structure. Number 3. Disciplined project selection. Projects are added only when exit visibility exists, operational capacity is available, risk return profile is acceptable. This ensures growth is controlled, not aggressive. We scale through systems and structure, not uncontrolled expansion. We run multiple projects through separate SPVs while maintaining centralized execution and risk control. We grow only at a pace where governance, due diligence, and investor servicing can remain strong. Our focus is not project quantity, it is execution quality. And the final fifth question: how do market cycles affect your investment strategy? Market cycles are a core part of GHL India Asset's investment strategy. Rather than reacting to market movements, we aim to align acquisitions and exits with different phases of the real estate cycle. Our strategy is designed around entry during bottom or recovery phases, exit during expansion or early downturn phases. How market cycles influence decisions? Number 1. Acquisition timing. During recovery or slower market phases, distressed opportunities increase. Seller urgency improves negotiation power. Acquisition pricing becomes more attractive. This improves downside protection. Number 2. Exit optimization. As markets enter expansion phases, demand increases, transaction velocity improves, buyers become more active. This creates better exit pricing and liquidity. Number 3. Risk management. In overheated markets, acquisition discipline becomes stricter. Speculative opportunities are avoided. Margin of safety is prioritized. This prevents overpaying during peak cycles. Number 4. Capital deployment strategy. Market conditions influence speed of capital deployment, type of assets selected, holding duration, exit timing. The strategy remains flexible, not rigid. Why Tier 2 markets matter here? Tier 2 cities often enter growth cycles earlier, offer stronger upside before institutional saturation, provide better valuation inefficiencies. This aligns well with GHL's cycle-based business strategy. We don't chase momentum, we position ahead of it. Market cycles influence both opportunity creation and risk management in our business model. We aim to buy during recovery phases and exit during expansion phases. Timing is a key part of our business strategy. Returns are not driven only by appreciation, they are driven by disciplined cycle positioning. Finding opportunities is only one part of real estate investing. The bigger challenge is managing risk, protecting capital, and staying stable through changing market conditions. In the next section, we will explore the advanced level of GHL India Asset's business structure, covering liquidity risk, valuation accuracy, project delays, legal protections, and the impact of macroeconomic changes on operations. Because strong investing is not just about growth, it is about control, strategy, and resilience behind the scenes.